Taiwan is down 1.4%. Hang Seng has actually recovered a fair bit. It was down over 1%.
The market had probably brought into the idea that the Fed was probably, close to being done.
The Defense Acquisition Council has given the approval for 24 capital acquisition proposals.
100 points low on the Nifty, straight off the back, and almost 400 points gone on the sensex.
It's a very mixed environment because of inflation, interest rates.
The after-sales business for us is something which keeps on going on and on. It's like an annuity type of a business.
The market, bright shade of red. I think Christmas belongs to the bears today.
The number of cases do seem to be on the rise in China. But remember, China is a very different economy. Vaccination coverage is much lower than India.
Day's low is very close to the 100-day moving average, guys. Which basically that's the level. 17,840 is the 100-day, and the low which was made was 17,857.
It's a case of teams spending big money to get the cricketers they really, really want in order to complete their squads.
Pressure on the market continues. We did see some recovery from the lows, but still it's a 220-point cut on the Nifty.
Okay, well, that was the day so far. You're with us here on Closing Bell. I'm Prashant. With me, my colleagues, Reema and Mangalam. Guys, deep shade of red. And I think, it's one of those days where nothing is getting spared. 261 points lower is what we have on the Nifty. Just a couple of points. I mean, we've basically taken some levels out. This is the low point of the day today. Maybe let's check if that has changed. I don't think it has. This is the low point of the day, 17,830. We were off the low point by just a little bit. But at the low, we took out the 100-day moving average. The 100-day moving average is 17,839, 840. And we broke that by about 10 points or so. 17,845 is also the 20-week moving average, which also got taken out, in the midst of this sell-off. So these are slightly more longer-term, moving averages, which are important for the trend, and we've kind of come off below those levels. Declines outnumber advances 10:1, so it's been pretty poor. Market breadth has been very, very poor. PSU banks are pulling back. Small caps, mid caps, metals, energy, the high beta part of the market is taking it on the chin. Global markets are down, nothing spectacular, but 0.5% to 1% cuts. Although, and I want to say this, that history does suggest last couple of years that we do get a bit of a bounce, starting around now. So will we see that is a question. And today, the Nifty kind of is just about 2.8% away from turning into the red for the year. The small cap index already did that. Now it's actually absolutely flat. The bigger question, though, is, and I think a lot of people are asking each other, what is going on? Why the sell-off? And I don't think there is any single one reason why this is the case. I think the most common answer which one is coming up with is this COVID scare out of China and how that may have a spillover impact in India. So far, just to make it absolutely clear, there is no indication of that. What the government is saying is stay vigilant, but there is no real big threat. That's the word coming in from experts, etc. as well. Not that the COVID variant in China is not already here, but the fact is the situation is very different between where India is and where China is. It's wave 2 for China, whereas here in India, we've dealt with wave 2, wave 3, and more over the last 3 years or so. China is just reopening after 3 years of being closed down. So it's but natural that they get a big wave. But that is the most commonly cited kind of a reason. I suspect perhaps there is a little bit of, sense of profit taking more than anything else. And today's session, today's sell-off, what we're seeing does seem a bit oversold. Does seem a little overdone. So we'll see if readings by the end of the session all move into oversold region, oversold territory. I would suspect that would be the case, which means when we come back next week, it's a bit more froth out of the system, bit more cleaner in terms of positioning, and perhaps, we start to see some bounce, some recovery. For now, it's deep in the red, 250 points. Reema.
Hi, Prashant. Hi, Mangalam. Forget Santa. It's Grinch who's visited Dalal Street today. Indices have declined for the 4th straight day in a row. And now with today's fall of 250 points, the Nifty is 1,000 points away from its all-time high level of 18,888 that it hit on 1st of December. So that's the extent of profit booking that we've seen in the month of December. The problem is the broader markets. They're tumbling hard, they're tumbling fast. The mid-cap index is down 3% today. This is the biggest one-day fall for the mid-cap index in the last 3 months. The mid-cap index has also now turned year-to-date negative, so it's erased all its YTD gains. The BSE 500 companies have erased the market cap gains of the entire quarter just in a span of 3 days. A quick word on how this week has panned out. While the Nifty is down 2.2%, the mid-caps are down 5%, and the Nifty small-cap index, that's taken it on the chin and has declined close to about 8%. And there's really nowhere to hide. All the sectoral indices are in the red, but it's the PSU banking index which has taken the biggest knock today. The Nifty PSU banking index is down 10% this week, with names like Central Bank, Bank of Maharashtra, South Indian Bank, IOB, UCO Bank, Union Bank, or roughly down close to about 10%. These are the stocks which outperformed from your rally in June, from the beginning of the rally in June all the way till the all-time high levels in December. And now the rally is unwinding fast, and furious profit bookings visible here, Mangalam.
That is absolutely correct. In fact, it is hot knife through butter as we speak, because not only has Nifty broken key levels today, but just the last few trading sessions, if you look at it, just a couple of weeks ago, we were saying that 20-day moving average is going to be an important support. Well, that's 18,528. That's a long way up from where we are right now. 50-day moving average, we were hoping that, the market meanders between that 20 and 50-day moving average sort of range. That got taken out yesterday, and, currently as well, we're way below that level, so 18,161. And on the way up, these are levels which will face, some sort of resistance because of the reverse polarity. And if you just take a look at the 100-day moving average, Prashant just briefly spoke about it, the Nifty bounced off from those levels, but the way, the ferocity with which the market's falling, it'll be interesting to see if this level gets actually held on to or not, or it faces the same fate as both the 20 and the 50-day moving average. I say that because the relatively stronger index, which is the Nifty Bank, also broke past the 20-day moving average in yesterday's trading session after taking that support for a very long time. And then the 50-day moving average got taken out today as well. 42,100 is where the 50-day moving average of the Nifty Bank is. It's 1,000 points lower where the 100-day moving average of the Nifty Bank is. So if the Nifty were to take the 100-day moving average of itself lower, then the Nifty Bank will look at that support only 1,000 points lower from here. But the story of the day clearly has been the mid-cap index. You guys have been talking about how it's turned negative for the year. But importantly, if you just take a look at the crisscross lines, usually we would say the lines would open somewhere closer to each other or divergent, move around, meander, and then we see a formidable trend. But today, right from the word go, we had almost 8 to 9 stocks declining for every stock that was advancing, and then those lines only went further apart, almost like a train track just moving away. We had during the middle of the day 10 stocks declining, then towards 1:32 it was 12 stocks declining for every stock that's advancing, and as we speak 15 stocks declining for every stock that is advancing. Only 180 stocks in the green for almost 2,800 stocks which are in the red. And a lot of these high flyers, Rima, you spoke about the PSU banks, etc. I'm just taking a look at big movers for the year. Garden Reach, we've been talking about the way defense stocks have done well. Well, Garden Reach is down in today's trading session, almost 8%. GE Shipping, a 120% mover this year, down 9%. Kalyan Jewelers, another 60% up mover this year, lower in today's trading session. Mazagon Dock, JK Paper, across sectors, these mid-caps, which had a lot of fire behind them from the start of this year to now, are seeing some money being taken off table. And these stocks usually face, the pressure of exits. Exits in these stocks get extremely difficult, and that's why we're seeing these big moves.
Mid-cap meltdown. That's what's happening today. Mangalam, thank you for that. Let's tell our viewers what's lined up on the show now. The mid-cap index turns negative for 2022 amid a broad-based sell-off as global pressures and renewed concerns over COVID spread take center stage. The Nifty mid-cap index slumps over 3%, while the Nifty, Nifty Bank and the sensex are down more than 1 percentage point each. We'll talk all things market with our market experts Prakash Diwan, Ambrish Baliga and Jay Bala. We'll also discuss top portfolio bets with our alpha manager for the day, Anshul Sehgal of Kotak PMS.
Okay, what are the trades to take? Mitesh is with us. Mitesh, hi, good afternoon. Welcome to the show. What would you do?
Morning, Prashant. Earlier in the day, we talked about the 100-day average and the gap level around 17,850. So in that sense, we have closed shorts on the index. We are not, seeing any signs of revival as yet. So while the index shorts have been closed because there is a support level, the overall structure still is in the weaker side. So the idea is that if you get a bounce back, you would have, again want to go short. And today's high and the gap down which happened today, around 18,050 is the level which I've marked for taking fresh short positions. For the time being, on stock specific basis, also despite the fact that we are at support levels, we are exploring some shorting positions. So HDFC Life is something which is given a breakdown. That's a sell. Keep a stop at about levels of 578 and look for targets of 555 to about 550. And Bajaj Auto is the other one, which is also looking slightly on the negative side. That's a sell with a stop below, with the stop about 35.75 for targets of 34.80.
Right, Mitesh, thanks a lot for those trades. We'll keep coming back to you through the course of the show. But as we speak, almost a 265-point decline on the index. Let's also welcome both Prakash, the one market expert, of course, and Jay Bala of cashthechaos.com. Thank you. Good afternoon, gentlemen, joining in. Jay, coming to you first, is there a possibility of the Nifty going further lower after a 1,000-point decline from the top? And would there be enough juice for the shorts right now?
Thanks for having me on the show, Mangalam. Let's go back to how the markets got here. I had when the markets registered low at 15,100, I had said the markets have the potential to rally on a counter-trend basis to somewhere close to 16,800 to 17,200. But once 17,200 got exceeded, I said that this market is either going to record highs or closer to it. But if it exceeds the record highs, there's a possibility the market will go lower than the 14,000 I've been projecting. I know you loved cricket parlance, so I would say the move between June to December is actually a dusra, and the markets was trapping the bulls, and we are probably heading lower below the June low on a 3 to 6 months basis. From the extreme short-term perspective, the support is about 17,800. And if that doesn't hold, we are looking at support about 17,500. My preferred path for the Nifty is something like 17,800 now, bounce to 18,100, and then come back to 17,500 from a short-term perspective.
Jay, you said Nifty can revisit the June low, which was about 15,000, 15,300, right?
15,183 to be precise, Rima. Okay. And this is not something new that I've been saying. I've been saying all through the rally that this is not a rally that's start of a new bull run. The correction that started from October 2021 is incomplete. It's still incomplete, and I'm still calling it a bull market correction. And the fact that the markets exceeded the all-time high at 18,604 of October 2021, that's what is giving rise to a deeper cut for the markets. This is a very atypical correction. Unless you are an Elliott wave analyst, it's very difficult to understand the market's move from June to December is a corrective move.
So all rebounds should be used to sell into the markets, even if we...
Of course.
Okay.
That's
so what's the best approach now?
We've been discussing over the last few weeks, Rima, that key sectors like banks and heavyweights like ICICI, SBI, they've been seeing cracks. And I've been pointing out that the auto sector, which was a leader from March to December, has been forming a head and shoulder top. That top is complete, and we are even seeing a lower low on the auto index. So use every bounce as a profit booking opportunity. If you are a trader, you need a little bit of a sharp eye to pick up shorting candidates from there.
Okay, we have Prakash with us as well. Jay, hi. Prakash, hi. Technicians can look at the price, right? They don't need reasons, but the normal sort of human brain needs reasons. Well, Prakash, and lots of questions. What is going on? What is the trigger? Maybe things had run up too hard, too much, and we were going one way, the world was going the other. So maybe things are getting a bit aligned. But this entire COVID business, Prakash, I mean, is that what is worrying big time, or that's just an excuse? Your sense?
Good afternoon, Prashant. So I think very clearly the market needed an excuse to correct, the kind of overbought situation that we were in. It had to kind of give in somewhere. And my sense is the COVID fears which are far larger than what the reality is, probably is the trigger for that correction to kind of come about. And remember, sometime back, we were all very eagerly waiting for a correction because there's still a lot of money waiting on the wings to be deployed. There are new sectors by virtue of rotation that are coming up. But then, markets don't oblige as and when you want them to. And that's precisely what this is a demonstration of. And my sense is, till valuations come down to a level where they start getting into that attractive zone, you'll probably see capitulation continue. But then for people who have dry powder left and who have planned for this, I think it's going to be excellent to cherry pick stuff which is already 15-20% down on the broader markets. And that's quite a bit, especially when you look at how sharply the market had moved up. So yes, it's a reset. Probably come Jan, we'll probably see much more clarity in terms of global markets as well. And that's precisely till when the pain could probably continue. I'm not too sure of levels and all, but when I look at stock-specific activity, I think it's all the overvalued stocks that are taking it on the chin. The value stocks still probably are holding themselves well, though there's also some correction there. But yeah, so nevertheless, it's going to be much more broader, much more deeper than what we've seen, and it's happened very gradually, but it's been very definitive. So maybe a couple of bad days continue, and then that's when the bottom starts happening. But specifically on stocks, I think it's a great opportunity to add.
Prakash, you said that you are not adept at levels and you don't want to guess levels at which the Nifty, etc., the indices will settle. But and that's not what we seek from you as well. What we seek is what you said is a great opportunity currently to go ahead and buy stocks. I mean, what are the ones that are swimming into your can after this 15-20% sort of decline? I mean, which ones are you tempted to buy? I presume that you have a lot of dry powder.
Yeah, so, given the limited time that we have, let me just focus on certain themes or sectors that clearly are emerging. And the first is real estate. Very clearly, we've seen the prices that we saw in the real estate segment, some of them selectively moved up. Some of the housing finance companies are looking very strong. Even at this point in time, irrespective of what's happened in the last couple of days or a week, I think, the likes of a PNB Housing Finance, some of the smaller, stronger banks like Federal and all, I don't see any reason why, if COVID doesn't get into, the economy in the same way as it did in, let's say, early 2020, why should, some of these banks start getting impacted so much? And these are resilient businesses built over long years of time. So it's not that, they're going to give it so easily. What you need to stay away from, Mangalam, that's precisely what I'm saying, is some of the names in the chemical pack, some of the names in probably, in the cement side, which probably might see some more correction, but real estate, railways, these are sectors where there is spending that's happening. And just to, tell you globally, things are actually looking up or could look up with this China plus one getting much more sharper if things really are going to slow down in China on the supply chain. So that's the thing. Keep away from IT, because I think that's another area where there is still some froth. And until January comes in, you will not have clarity. So I would definitely keep on adding into these pockets. Even the likes of Indigo, which we spoke about the other day, where it was getting impacted because of this COVID fear. I don't see any let up in travel or some mechanism to come around this problem and continue to grow at a fast clip. So there are very good opportunities. It's just that the market is resetting itself in terms of the price earning multiple. The EPS growth, wherever it is intact, will continue to offer great value.
Prakash, you said avoid chemicals and cement right now. And of course, IT, but wanted to get your thoughts in on why chemicals and why cement.
So yeah, that's interesting that you ask me this, because chemicals, most of the chemical players in India, had the benefit of supplying to Europe. Basis, a lot of the things that they were raw material that was coming in from China. Now, if China were to start either consuming its own chemical, if things are as good as what we would wish it to be, or if things are really bad as the news flow is indicating, then you will have a shortage of APIs and intermediates and a lot of the raw material that go into making final goods for the European market. On the other side, the demand contraction that we are seeing in chemicals within the European market is very real. I have spoken to some large chemical dealers in Bombay, and the picture is quite grim because they haven't seen orders come through for the last two and a half months. So, and chemical stocks were always riding very high on multiples, which factored in growth to continue for the next couple of years, because of capacity additions and things like that. But unlike chemicals, you look at some of the players like sectors like paper, for instance. I know I'm taking it off the track from the chemical side, but paper businesses are likely to continue to do very well because they actually don't have any dependence on China in that sense, and in fact, they substitute a lot of the Chinese supplies. So that's where you would need to look at. Integrated paper players would probably be far better than a chemical name which is reliant on raw material inputs from China and exports to Europe. So that's the kind of mix that's very clearly happening. So I would stay away from that. And cement is, of course, just because of the kind of momentum that we had seen built up. Nigel is not on the show right now. Otherwise, I'm sure he would add to it that some of the cement names had done 30-40% in a very short period of time. And whereas the earnings will still take time to catch up, and that could probably happen middle of next year.
Okay. By the way, the market has broken through a new low for the day. 17,830 was the low early so far, and we've basically come off a little bit more. So the low is 17,816 now. So that's a full 300-point cut on the index that we have right now. Jay, are at least in the near term, are things getting to a bit of an oversold zone, in your opinion? Yeah.
That's right, Prashant. From an extreme short-term perspective, I'm looking for a low, but as a trader, I would look for some kind of drop in momentum to come through on a 15 minutes to 1 hour time frame. But I'm just watchful of it. If that comes through, we can have that extreme short-term bounce to somewhere close to 18,000, 18,100. But from a slightly higher time frame, the markets have got a little more to do on the downside.
The other thing which is a little different is that every time, for as long as we can remember, at least I can remember now, one has gotten habituated to the fact that the dips don't last, right?
Yeah.
If they kind of get bought without fail every day.
And very quickly.
Right? Which is, so yesterday and today are stand out because that's not played out, right? And it's a powerful thing. You something has worked for so long, so buy the dip and you end up making money day after day after day for weeks, for months. So we'll see. This is really one of those change in regimes, which is buy the dip, and now, as Jay says, maybe time to sell the bounces, sell the rallies. That will only become clearer with time. But in the very near term, perhaps things are getting a little excessive.
But it's also the fact that towards the year end, volumes are on the lower side. Gross volumes are lower. Today, UK markets are shutting half day on account of a Christmas leave. And there would be a lot of people on leave as well. So I'm saying that also exaggerates the price action that you would see.
It does. Actually, volumes today on the Nifty, for example, I can see it right now. They are, for this time of the day, they are lower.
Compared to?
Compared to yesterday, compared to day before yesterday. Day before was a big volume day. But generally, volumes have been coming off all the way from... the high that we saw was on the 14th of December, 14th of this month.
The recent high, the all-time high was on 1st December.
That's 14th of December was a pretty strong number for this Nifty volumes.
Yeah.
And they've today, but there's still 45 minutes to go. And whereas the previous days are all end of day volumes, so we just need to account for that. But in any case, that's a point which is true not just here but around the world, that participation, of course, is thins out this time of the year. 17,834 on the index. We take our first break on the program. We are back. Jay and Prakash, of course, are with us. We also will have Anshul Sehgal of Kotak PMS join us on the other side. Stay with us.
Welcome back. Still down 300 points on the Nifty. Sensex lower by 765 points. There is carnage. There's a bloodbath in the broader markets. The Nifty mid-cap index is down 3.3%, and pull up the small cap index, and that's got a cut of close to about 4.25%. For the week so far, the small cap index is still down close to about 8%. And remember, this is an index which is anyway underperformed. Year to date, while the Nifty still has a slim gain up to 3%, the Nifty small cap index is down 18-19% so far this year. So there is no reprieve in sight even as we approach the year end. But it's the final 30 minutes of this week, and this, remember, is the penultimate week. We've got Jay Bala of Cash the Chaos with us, and he was telling us earlier how the Nifty is probably headed back to its lows, June lows of 15,000.
June lows. No, Jay is not smiling. Jay is Jay.
A little bit of a frown.
It's not a frown either. He's a pragmatist. Jay, but this very near-term bounce, this 200, 300 points is possible. You don't want to trade that, do you? You want to stay with the bigger trend, which is down according to you.
Yeah, I mean, as a day trader, swing trader, I mean, why let go of so many points? You know, for me, it's always risk that trumps everything else. If you can find a low risk entry point, you know, which allows me to get in with a reward ratio that's about 2.5 times the risk that I'm going to take, I will definitely pull the trigger. But at the moment, you know, I've not yet seen a reversal, so I will not pull the trigger yet. So, but if the reversal bar comes really quick, you know, then the risk will be quite wide. Then I will avoid the trade.
What about Prakash? Anything else? You know, you began by saying that maybe a few more days of few more down days, and then maybe things stabilize a little bit. Is that your kind of near-term view?
So, you know, Prashant, what's happening is the ferocity of the fall is what's spooking the market. I mean, and people who have positions in some of these constituents of the broader markets would probably rather panic early if they had to panic. You know, so because liquidity becomes an issue. If you don't have buying on the other side, it becomes extremely difficult to do it at a low impact cost. So my sense is the first 2-3 days of this panic has actually explained to people or made it very clear that some of these small caps, mid caps would probably be in for a very rough drubbing if things go bad. And that's what people are doing in terms of lightening their position. So my sense is once that happens, you'll probably see that get going off. And the other interesting thing is that the data from, you know, the global data in terms of the recession and all the fears related to inflation and all, that is actually not as bad. So if any positive trigger comes through on that front, or maybe from the Russia-Ukraine conflict, you could probably see a very clear bounce back. But you know, we're not talking about a technical bounce back, but you're talking about probably value buying coming into some of these names. So, you know, beaten down sectors, beaten down names, that's what you need to look at.
All right, Prakash, thanks a lot for that. In fact, on that note, we'll thank both Prakash as well as Jay Bala for joining in and giving us their views on the market. And gentlemen, of course, we will see you, you know, we'll try to see you before the New Year's, but we won't see you before Christmas. Wish you guys a very Merry Christmas as well.
Thank you.
Let's also welcome Anshul Sehgal, who is the Executive Vice President at Kotak Portfolio Management Services. Anshul, thanks a lot for joining in. Season's greetings. This Christmas is actually more red than green for the stock market, at least this week. You know, you've been making the point that we managed to hold on into the green despite the massive sell-off by FIIs. The question is, how long does it hold on for? Because now we're barely about 2.5% into the green, and the FIs have sold almost what, $34 billion in this calendar year itself so far. What's your prognosis for 2023, and what happens to the index?
Good afternoon. Thanks for having me, and season's greetings to you as well. 2023 is likely to be a volatile year. 2022 has been, you know, again, it's been a very narrow market in 2022. If you were invested in the broader markets, probably you didn't make much money. If you were in the right stocks in this year, you obviously made a lot of money. Look at what happened to the PSU banking space. And at the same time, the darlings of last year, which is the IT sector, that sector didn't do too well. So essentially, this is a year where if you had some understanding of visibility on earnings, you made money. And if you were out of such names where there was visibility on earnings, clearly it was a tough time in the last year. Next year is likely to be somewhat similar. It is going to be a narrow market. You've got to choose your pockets much more with much more distinction. And I do believe that next year is a year where you will be able to make money if you're in the right pockets. With the recent correction, I'm spoiled for choice. There is a lot of opportunity in the markets. Of course, you've got to, as I said, seek earnings visibility. As long as you've done that, hard to go wrong in the next year.
Anshul, just a good afternoon. Very near-term, here and now question. What is it's a sharp correction, right, today and yesterday as well. What are you picking up? I mean, what's the dominating driver narrative right now? It's just a pullback, profit taking, but it is forceful. That's why I'm asking that.
You're right, Prashant. Good afternoon. So in the near term, if you see what is happening today, as also in the last 2-3 days, you've seen the pharma sector do well, and you've seen most other sectors, particularly the cyclical ones, those getting impacted fiercely. Now that tells you that there is clearly a thesis that is being created by the markets that COVID is probably back. And as a result, pharma companies are going to benefit, and cyclical sectors, say the financials, particularly the financials, old world financials, which have of late done well, but have a history of being overtly cyclical, those names are going to get hurt. And that trade has played out in the last week. Many PSU banks, nearly a month, 2 months returns have been given away in the last 3-4 days. So clearly that is the thought process of the markets. And it was warranted also. Indian markets were expensive. They needed to correct a little bit so that a base is formed for the next leg of the rally. And I wouldn't be too perturbed as long as earnings remain steady, our GDP growth expectations don't get downgraded, and corporate earnings also don't get downgraded. As long as that happens, I'm a believer that this correction, and if there is more to come, is only healthy for the markets.
Anshul, so you are betting on stocks with good earnings visibility to do well even in 2023. You know, if we had chatted same time last year, we would have never anticipated the earnings recovery that we've seen in the banking space, even in the large cap private sector banks, in the PSU banks. As we speak today, can you tell us some sectors, some stocks which are at the cusp of a turnaround in their earnings or a big acceleration in their earnings growth, something that the street has not priced in yet?
Good afternoon. Just like last year, PSU banks as a space was not anticipated to do too well this year. We anticipate that in the coming year, NBFCs will be in flavor, and particularly NBFCs which have been forgotten about in the past. There are many NBFCs whose stock of liabilities is fixed interest rate in nature, and their assets are variable interest rate in nature, which means that they will see an expansion of their spreads. Now, these NBFCs, many of them are trading at really throwaway valuations. That, in our judgment, is going to change in the next year. We see defense. I mean, just yesterday we saw 84,000 crores of order booking by the Indian military. And 97% of that, somewhere close to 82,000 crores, was towards indigenization. Now, this is a trend which is going to catch pace in the current year and going forward. That space should do well. Real estate is only at the beginning of a multi-year cycle in our judgment. Both real estate developers as also downstream companies are going to benefit. So these are some sectors that we are quite positive on. And then there are, of course, individual opportunities, say in the PLI space, electronics manufacturing space, which will be beneficiaries.
All right. Just on a couple of these stocks, 2021, the start of 2021 on the Nifty was definitely Tata Motors with over 130, 140% sort of gains coming by. This year, while all the other auto stocks did do well, Tata Motors was the one which was lower by almost 20-odd%. You spoke about opportunities being there in individual stocks, etc. I mean, is there anything that really stands out for you that you think can do extremely well in 2023?
I would refrain from talking about individual stocks, but I mean, we are seeing opportunity, a lot of opportunity across sectors. Even before the recent bout of correction, many small and mid caps, and in fact, you only mentioned prior to my coming on air that the small cap index is down 19% year to date. Now that tells you that many stocks have corrected more than that. And I must mention that many quality stocks having ROEs in the region of 20+% and long-term growth trajectories of 20+% earnings growth. Such companies have corrected 30, 40, 50% in the current year. Now we see opportunity there. Many of these are related to diverse sectors, say the air conditioning space, say the electronics manufacturing space, the fast-moving electrical goods space, NBFCs, sugar, for instance. There are segments of the market where opportunities have arisen, and those have arisen prior to the recent bout of a correction. So I do think that for the discerning investor, next year is going to be a year of laddus.
No, absolutely. Look at the market, by the way. Another leg down. This is the last and not the last, but the latest leg down, which is sliced through 17,800. If you can have the intraday up, and now it has basically made a low of 17,780. So another 30-40 points gone just like that, very quickly on the index right now. So this is a very sharp. Now this is approaching the 2%. When is the last time we had a full 2% fall, sort of 1 day fall? I think you'll have to go back some time to get that. So that is what we have right now. Anshul, I was saying this earlier that the general mindset has been that you buy the dip and you make money, right? But yesterday and today things are that has not worked. And we've had a forceful kind of deleveraging, sell-off, whatever you want to call it. Will that mindset also change? Are we at the cusp of a bit of a change there as we enter the next year for the broader market?
Prashant, I couldn't agree with you more. Investors have a tendency to seek patterns and invest behind those patterns. Now, markets, again, don't oblige. Markets, as long as you're investing behind certain patterns and there is a convergence of the market towards one pattern, markets tend to surprise people on the other side. Another pattern that I could speak about is the year before elections. Go back 20 years and you will notice that whether it was 2003, 2008, 2013, 2018, all these years saw a correction in the markets. But that doesn't mean that this is a pattern that is going to be replicated next year. It may be, but it may also not be. So the point being that patterns, while you should have them at the back of your head, but investing, in line with patterns is not always correct. So that's our view on this. And so, I mean, just thinking that because the markets are down 2%, we should be investors, that is speculation. It's better to look at quality names. If they are cheap and you're a willing buyer for the next 12 months to 24 months at these prices, then it is a good time to buy.
Anshul, thank you so much for joining in. Always a pleasure speaking with you. Wish you a very happy new year. And may you make a lot of money in 2023. Like you said, there are a lot of opportunities as well. Thank you. Let's talk about the market itself. We have the India VIX, which has rallied about 7%, 12.5% off lows over the last few days. We saw the India VIX meander around that 11, 12 sort of mark, and everyone was thinking that there could be some sort of complacency which is being built in. And in just this week, we've seen a rally of almost 15, 16% on the VIX. The VIX now above that 16.3 mark is the highest that we've seen in at least the last 2.5 to 3 odd months. So that's a big move that we're seeing. And what are the dealing rooms saying now? Because that's a question on everyone's minds. Nimesh, yesterday you joined in, you said that, despite the decline, there was not much institutional selling. In fact, there was institutional buying.
Correct.
That's what the data indicated as well, a mild buying by the FIs and DIS. Today, what are you hearing? Is there a big selling?
It doesn't look like it's a big selling, but honestly, today I don't have enough handle on what's really happening. There is sheer panic on the street now, and largely from the non-institutional investors. And that explains the big fall in the mid-cap and small-cap. Technically, we've broken. Yesterday I spoke about 18,100 as an important level to watch out for. If that gets taken out, the next level is 17,830, which is a 100 DMA. Even that's taken out now. So that's that's a bit of a panic selling now on the technical front as well, and that is clearly visible in the mid cap and small cap. As I said, as we're heading towards the year end, the flows are going to taper off a bit from the large institutions. Today, the understanding is half of the desks are not even there in dealing room.
Yeah.
So that's going to be the trend for the next few days. At least from an institutional point of view. I guess that 17,830 was a very crucial technical level, so that's broken now. Maybe that will open up floodgates for further sharp sell-off. But I guess the bigger worry today was the pain in the mid-cap and small-cap. The way the mid-cap and small-cap have capitulated, it looks like the non-institutional investors have thrown in the towel, and they are panicking now. Look, there is a bit of forced selling as well, is what I understand from brokers for retail and HN investors. So that's also playing out in today's trade. Again, it's very difficult. As I said, today is a day where I'm struggling to find out whether there is genuine selling from the larger institutions. Looks like there will be some negative number from the larger FIs as well. But the bigger panic is in the mid-cap and small-cap, and that's from the non-retail investors, non-institutional investors, and that's playing out in the broader markets today.
HNIs are panic selling. Well, you said that half the dealing room is not even working. So does that mean that it'll be incrementally difficult for you to even find individual stocks?
It will be difficult. Mangalam, there is no doubt, no two ways about it. If you look at next week, Monday, US markets are shut. UK market is going to be shut. So there's going to be a lack of cues from the global markets as well. I understand many of the Asian desks in Singapore and Hong Kong are going on leave early next week. So, that's going to be the challenge. And again, the flow, even the volumes are going to be on the lower side, in the next few days from here on. So that's typically a year-end phenomena which happens every year. And that's going to be no change this year as well.
So no chatter?
No chatter. Hopefully no chatter. I mean, I'll try and see. But today there is no point of putting out any chatters because, the big chatter is market why markets are falling. And nobody has an answer to that. So no point giving out individual names.
All right, we'll give it back to the studio. We were hoping that Nimesh brings up a list of a few stocks that we have to watch. But he's saying that half the dealing rooms aren't even in their place. So there's definitely no chatter. Is there anything else that you want to ask him? Now that we have him, he doesn't have any stocks. Maybe something for Christmas?
Prashant, go ahead.
Well, it looks like it's become a big pressure on me, Prashant, the way Mangalam is asking you for chatter. I think that's a big challenge as well, to get in 4 stocks every day and talk about it.
But you do a fantastic job at that. You raised the bar.
अब आए हो तो बता दो दो तीन stock.
No, honestly, there is not much to talk about today. I mean, frankly, the whole mood is very sour. Everybody is asking about what went wrong, and nobody knows the answer, right? I spoke to so many dealers who are actually there in the market today, and nobody has a handle to what went wrong. I guess the whole chatter in the market today is this COVID fear for real? That's a big question mark. And that explains the kind of fall we've seen in many of those consumption-led stocks. The PVR is down 7% in today's trade. So, that looks like that's a real fear in the market, especially from an India point of view. And the other point is, we've been highlighting this for a while now, that India has been a rank outperforming market. So, towards the end, we're seeing some bit of profit booking, and nobody's willing to bet. And the fact that today's a Friday, so no fresh position is what even the retail investors are willing to bet today.
Yeah, no,
Like the Black Friday, right?
I put
Red Friday.
I blame it on the red. But on Market Laser in the morning, I put out PVR, right? PVR in Indian hotels were 2 names.
Yeah.
Now that I can, one can understand, right? But this wide, if it is, it's tough to say, right? Whether this, as Nimesh also said, as we've been saying, is it really COVID fears that, I'm not sure, because if it is that there is some apprehension, the impact is on discretionary things. You probably postpone watching a movie that you want to watch, or and things like that.
But you've been burned before once by COVID, right? If you are sitting on some gains and you do not know what the future is, the next 3 months, 6 months, and everyone is saying, right, that there is a disconnect between the market and what the Fed is. If the market has got it wrong, why not just take profits, right? Use it as an excuse and take profits.
I'm just saying COVID is the reason. I'm saying COVID is the reason. the impulse
COVID
now
is an excuse.
as an
Vivek.
excuse, yeah. I mean, as a latest kind of incremental reason, that I'm a little baffled. That why is that suddenly such a big issue? Even if that is an issue, I would say it's just maybe just an excuse. At some level, there may be a little bit of fear, trepidation, etc. as well. But we'll see. Nimesh, thank you very much for that. 300 points, 320 points lower, 17,810 is what we have right now. Now, let's get you some sort of end-of-the-year wrap-outs as well. And we've been kind of going sector on sector. Today, we're talking about real estate. Decadal high absorption, massive decline in inventories, and sharp increase in prices across segments. These are some of the highlights from the residential real estate sector in 22. The only worry, rising interest rates. Sonal wraps up the real estate sector and highlights possible risks to the upcycle. Sonal, over to you.
...2022 was about a lot of things. An uptick in real estate cycle is definitely something worth highlighting. We are talking about a steep uptick in residential demand and sales. So let's look at some numbers now. Absorption in residential real estate is not 1, 2 or 3-year high, but at a decadal high. Absorption in residential real estate is basically the amount of space or units which are occupied within a market over a given period of time, typically 1 year. In calendar year 2022, so far, it is at 447 million square feet, which compares with 400 to 425 million square feet that we have seen in past couple of years. It even dipped to 281 in 2017 when the cycle was undergoing some decline. While absorption is increasing, inventories have been declining. Unsold inventory was a big pain point for developers as supply was exceeding demand. But now trends are seeing a reversal. Ready-to-move-in inventory is declining. From levels of 849 billion in 2019, it is now around 500 billion, and that is a big decline. That is for ready-to-move-in inventory, which was still more resilient than under construction. So if we look at the under construction segment, that has declined from calendar year 19 to calendar year 2022. Calendar year 2019, remember, saw a massive increase in inventories. So barring Hyderabad, in the top cities, there is a decline. 23% for Mumbai, 29% for Bengaluru, 14% for Chennai, 20% for Gurugram, 4% for Delhi, 34% for Pune. Only Hyderabad saw an increase of 145% in inventories. Decline in inventories was accompanied by increase in prices. We have been speaking to a whole host of developers, and they have been of the view that passing on price hikes in the last quarter was not very difficult. So price hikes in the September quarter in some geographies have been massive. 3 to 4% in Mumbai, 14% quarter-on-quarter for Delhi NCR, 30% YOY there. Hyderabad has seen a 10% price increase. Navi Mumbai at 14% YOY, up 8% sequentially, and Chennai has seen a decline sequentially, but an increase on a YOY basis. Bengaluru and Pune have also seen moderate price hikes. This is across the industry, including organized and unorganized players. But some experts are of the view that maybe it will not be easy to pass on price hikes now, considering the massive hike in interest rates as well as the inflation. If we look at how listed players have done, strong first half of FY23, more than 100% growth in some cases. Prestige, Macrotech, Mahindra Life Spaces saw more than 100% growth. We have Godrej Properties and DLF with more than 60% growth in bookings, Oberoi at 92%, the likes of Sobha, Kolte Patil, Brigade and Suntech between 20 to 50%. So, what could the risk to this massive rally be? Definitely rising interest rates. RBI has hiked rates to 6.25% in last few policy meets. And we did ask some big real estate names, and DLF told us that demand for real estate sector was impacted when mortgage rates were at 9%, while Prestige Estates told us if mortgage rates cross 9%, it will impact real estate demand. So rate action from the RBI will be key to watch. Ending this data with some news we got some time back. This is related to commercial real estate, but only goes on to show the impact of rising rates. Blackstone and Starwood Funds Limited saw withdrawals from their real estate funds, and this was following surge of redemption requests. Big and small investors were queuing up to pull money out of real estate funds, which is a sign that yes, the surge in interest rates is threatening to impact at least the commercial property sector. These are two isolated cases, but whether it starts to have an impact on the entire sector, we'll wait and watch.
Welcome back. Still down 300 points on the Nifty. The Nifty right now at least is holding on to 17,800. But this has been a very ugly session. In every hour, we've seen the markets go lower and lower. At one point of time, down 50, then 100. Next time you look at the screen, it's down 200 points and now down close to about 300 points. Videsh Thakkar has been negative on the markets for the last couple of trading sessions. And he's been advising for people to go short, either directly go short in the futures or perhaps buy put options. Let's find out what he's now advising in the BTST trades. Mitesh?
Good afternoon, Rima. I think while we are looking at some oversold readings, I think there's still no sign of a concrete reversal. So, given that kind of situation, we'll still trade with negative bias on the markets and take some STBT positions. DLF, I would recommend selling with a stop at 362. So keep tight your stop losses a percent or so, with a stop at 362 for targets of 350. And the other one is sell or STBT on Hindalco, with a stop at about 436.5 and look for targets of 425 for tomorrow, Monday.
Okay, all right. Mitesh, stay with us. We'll keep coming. Any stocks, by the way, anything which comes to your mind for reversals, trades, anything more?
Prashant, see, the only reversal which I'm looking at right now is bounce back from oversold levels. Typically, these bounce back get sold into again, so nothing positional because there's no accumulation which has happened after the decline which has started. So I think that accumulation phase has to come into place before we see a significant reversal. The bounce backs will not interest me, but rather I would use them to sell at higher levels. So if we get back to 18,050, 60 or 18,100 on Monday or Tuesday, I would once again want to add on to or take fresh short positions on the index which we have covered today.
Yeah, no. I mean, in the very near term, though, Mitesh, you agree, right? This is a bit oversold.
It is, but that still does not confirm a reversal. I think we have seen oversold levels in markets.
Getting more oversold, yeah.
Exactly. Yeah. So I think for the timing, take your profits in shorts, wait out if the bounce back plays into your hand. That's a good level to go short, or see some accumulation and reversal at lower levels and then take longs.
We've got market expert Ambarish Baliga as well joining in. Ambarish, hindsight wisdom tell us that you should buy into any dips, and today markets have given you a big dip, right? 800 points gone in the sensex. Were you brave enough to go ahead and accumulate any stocks, and if yes, which ones and why?
Good afternoon, Rima. In fact, I was indicating this last week itself when we were discussing. And I had told you that once the market breaks that 18,200, 18,400 range, we could see a sharp correction. And now it's only been about a 400-point correction below that range. And many of the portfolios are today 20 to 25% down. So, in fact, I had also indicated that we are about 30% in cash. And that's exactly what we'll start deploying now, going ahead. Because in the longer term, you really can't go wrong on India. So one of the stocks which I would surely suggest people to buy is Tata Chemicals, which is the world's third largest producer of soda ash with facilities in Asia, Europe, Africa, and North America. So other than soda ash, Tata Chemicals also manufactures sodium bicarbonate, cement, salt, and marine chemicals. And they have a strong focus on consumer, agri, and specialty businesses. And if you look at the Q2 earnings, they were strong across the board. EBITDA was up about 84%. PAT was about 3x of last year. And generally in monsoons, what we notice is detergent market, which is the end user for soda ash, the demand is dull. But Q3 onwards, it again picks up. So Q3 and Q4 should be much better. And if you look slightly longer term, Tata Chemicals is clearly on track as far as the capex plans are concerned up to 2027. And globally, if you see major capacity additions are not happening till 2030. So competition is under check and margins should improve. And I'm expecting an EPS of about 74 in FY24. So my target is 1,332. But since the stock is in a correction mode right now, but still I feel the downside is limited, I would suggest looking at the market conditions that one should be buying this in about 3 to 4 tranches, not in one shot.
Okay, buy in 2 to 3 tranches, not in one shot. That is good advice. Amrish, very short conversation because we are at market closing now. So thank you very much for joining us, as always, here on the program. 300 points lower on the Nifty. We are at 17,825. Although I think the market did break the lows of, and made it broke 17,800. The low today is 17,779. That is from there the market bounced a little bit by about 40-45 points or so from the low point, from the absolute low point. But very swift, very forceful moves coming through in the last 1 hour and through the course of the day. Banks sold off 1.7, 1.8% in line with what the Nifty did. The mid-cap and small-cap indices had it much worse. So I think the mid-cap index sold off 4%. Now that is a very large cut that we have on our hands. You also have the small-cap index, which sold off 4.5%. So 92.11. I mean, the small-cap index for the year, I think, is down 20%. The mid-cap index has just turned red. So there's a very large difference between where both these are for the year. Most sectors, I mean, actually, except maybe pharma, all sectors in the red. PSU banks, top of the list in terms of losers. Small caps, mid caps, I just mentioned. Metals, high beta, sold off aggressively. And you had the energy index, which was down almost 4% as well. Rima.
When was the last time we saw a market breadth, which was one stock in the green for nearly 12 in the red? 2,800 stocks closing in the red on the NSE. So the broader markets were bleeding today. And the bears were completely in charge. The Nifty PSU banking index was down more than 10%. Names like IOB, Union Bank, Central Bank of India down anywhere between 10 to 15%. A couple of these hospitality, contact-intensive sectors like Ease My Trip under pressure. Really, no place to hide today. There was one lone stock which comes up on the price and on the volume chart, and that's Morpin Laboratories. 43 rupees is the stock price, ends up with a gain of close to about 19%. It's a bit of an unexplained up move coming through. All in all, this has turned out to be a very ugly session for our markets. We've broken key support levels, and the ferocity of the sell-off has come in as a bit of a surprise. But guys, it's Christmas now, finally. Monday is an off for the US markets. We're not going to be getting in any global cues on Monday. US markets shut today, but we'll be back. But have a wonderful, enjoyable Christmas. Forget what happened in the markets and go out there and enjoy. We're going to wrap out on closing bell, but don't go anywhere because our Friday special, Smart Money, comes up next.